Picture this scene. You've been waiting 20 minutes, standing perfectly still exactly underneath the city bus stop sign. Finally, the bus arrives, but instead of pulling up to your exact spot, it stops 10 feet short to let a crowd on. You wait for the driver to pull forward to your sign, but they don't. The doors close, the bus pulls away, and you are left standing alone on the sidewalk. You were positioned exactly where the marker told you to be, but by expecting absolute to-the-inch precision, you completely missed the ride. When people first start analyzing financial charts, they make this exact same mistake. They draw perfectly straight, razor-thin horizontal lines to mark where they want to buy, a concept often called support. This chart shows price dropping toward a rigid target line. The trader waits for it to touch that exact millimeter. But the market has momentum. It slows down right before the line, turns, and rockets upward into massive profit. The trader is left behind, staring at a precise line that was essentially useless. To fix this, we need to stop staring at the thin metal signpost and start identifying the broader loading zone. In trading, we call this zone the order flow. By treating the market as a designated area rather than a strict boundary, you give yourself a realistic margin of error. This wider net makes sure the market doesn't drive away without you. To find these loading zones, we first need to understand how prices actually move. Even when a market is aggressively climbing, it never travels in a perfectly straight vertical line. This diagram shows a standard upward trend moving in a natural zigzag pattern. It pushes to a new high, then dips back down. We call these downward dips pullbacks, like a runner catching their breath before the next sprint. It is highly tempting to look at every single one of those drops and assume they are great places to jump in. But those general, random dips are not order flow. When you mistake normal market noise for a structural area of support, you end up buying at a moment when the price is actually preparing to drop further. That confusion is a very quick way to lose money. So how do we separate the random dips from a genuine loading zone? Using real market data, our first step is locating the exact moment the market surges and shatters its previous high. Once we spot that upward break, we work backwards, finding the final downward wave just before that massive surge. That specific final downward breath before the jump is our true order flow. Now, instead of a razor-thin line, we draw a generous, semi-transparent box around that entire downward move. This is our new loading zone. By tracing the actual visible history of where the buyer stepped in, you create a realistic catchment. This simple adjustment greatly increases your ability to successfully capture the next major upward wave. But real charts can get messy. You will often look at a screen and see multiple order flow zones stacked right on top of each other. Think back to our bus from earlier. If a bus has already stopped at a particular corner and picked up every single waiting passenger, it has absolutely no reason to stop there a second time. This chart shows two stacked loading zones. The price previously tapped the top box and bounced. Its buying power is used up, a mitigated zone. It falls straight through that used up space, finding the untouched zone underneath, an unmitigated order flow. By identifying and crossing out those used zones, you eliminate false safety nets. You protect your capital, ensuring you only risk your money in areas where real buying opportunities still remains. Let's review the exact steps. First, watch the market as it climbs and spot the moment it breaks past an old high. Second, trace your eyes backwards to find that final downward dip and draw your order flow box around it. Third, check your history to ensure no other price drops have used up that area. Then, wait patiently for the price to return to your fresh loading zone. Analyzing the market doesn't mean punishing yourself with millimeter precision. When you start mapping the broad natural zones where buyers actually gather, you can stop missing the bus and finally catch